To the Sumitomo Chemical India Limited Q4 and FY25 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant line will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need the assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. From the management today, we have on the call Mr. Chetan Shah, Managing Director, Mr. Sushil Marfatia, Executive Director, Dr. Suresh Ramchandran, Deputy Managing Director, Mr. Kunal Mittal, Senior VP, Planning and Coordination Office, Mr. Anil Nawal, Chief Financial Officer, and Ms. Deepika Trivedi, Company Secretary, colleagues from SGA, their Investor Relation Advisor. Now, I hand the conference over to Mr. Chetan Shah, Managing Director of Sumitomo Chemical India Limited. Thank you, and over to you, Mr. Shah.
Thank you. Ladies and gentlemen, a very good afternoon to all of you, and welcome to the conference call to discuss Q4 and financial year 25 financial performance of our company. First of all, let me begin with saying that India's agriculture sector continues to play a foundational role in the national economy, accounting for almost 46% of country's employment in financial year 24, up from 44.1% in financial year 18. Improvements in irrigation coverage, input availability, institutional credits have significantly bolstered the sector's resilience against climatic shocks. These strides are now translating into robust output, with record production achieved in financial year 24-25 and a targeted 1.5% year-on-year increase in Kharif food grain output for financial year 26. India's farm exports tell a compelling story, more than doubling over the past decade to surpass $48 billion, outpacing growth in both manufacturing goods and services. Despite intermittent export restrictions, India's agricultural policies have demonstrated their global impact, with price shocks reverberating across international markets during export bans and on staples like rice and onions. India's agriculture sector is an inflection point, with strategic policy support, enhanced awareness, and technological integrations. The industry can not only meet domestic food security targets, but also fortify its leadership role in global agri-trade. The domestic environment for agricultural inputs has recently seen a turn for better, underpinned by favorable monsoon and a strong Rabi season, signaling green shoots of recovery. On the global front, the agrochemical export landscape continues to grapple with pricing pressure and climate volatility. Nonetheless, with channel destocking largely behind us and ordering patterns normalizing in key export markets, the industry is poised for gradual stabilization. Prices appear to have bottomed out, providing a base for recovery in subsequent quarters. Before I invite my colleagues to share more information on our company's performance, I would like to highlight a few important points. In financial year 24-25, our team delivered 20% volume growth in our branded business in Indian domestic market and 30% plus volume growth in exports over last year. In addition to several premium branded products in our existing portfolio, several products newly launched in the last 3 years or so contributed to this volume growth. We are extremely pleased with our team's performance to deliver such volume growth. Our team also delivered highest level of profitability in financial year 24-25. both in terms of absolute PAT numbers and also in terms of percentage margin across all levels, EBITDA and PAT levels. Further, we are ready to launch several new products in financial year 25-26. Among such portfolio, one newly launched patented global blockbuster product deserves special mention. The product Indiflin, which is a original which is formerly a Japanese innovation by our parent company, has demonstrated impactful performance in few markets wherein this was launched in last couple of years. We are also thankful to Indian regulatory authorities for granting fast-track approval of this product under a special window for new global launch products. Our teams are launching this product in India under brand name of Excelia Max, and based on various technical evaluation and field trials data of global performance and in India, we feel this can be a next blockbuster product from Sumitomo. I request my colleague Suresh to talk more about this very soon. Before that, I think it is also important to mention that the technical or the active ingredient, as we call it, for this newly launched globally blockbuster product will also be made by us in India within next 12 to 15 months. This will be made in our existing Tarapur plant, and all the trials and technical evaluation has been completed. While we are finalizing plans to set up new greenfield plants at Dahej for manufacturing multiple products for our parent company SCC, we thought making this newly launched global product at Tarapur in interim period would help us accelerate ramp-up of this production in Indian market and also provide early experience of manufacturing new patented products to our projects and manufacturing teams. This experience would be very helpful to leverage when we set up larger level greenfield backward integrated plant for global requirement over next couple of years. Our Dahej plant remains intact. We already have secured the environment clearance valid for 10 years. Planned capacities requirements and our overall site layout designs are ready. We plan to soon start work on setting up multiple greenfield plants at Dahej for multiple SCC innovated products and intermediates, and technical studies for the same are in very, very advanced stage. We plan to invest, as informed earlier, an initial investment of 300 crore to start with, and we are prepared for more investment depending on the number of products we finalize and the time that will be required to put up each and every plant. This Dahej manufacturing capacity expansion initiative is very strategic long-term growth strategy for us at SCIL as well as for our parent company SCC, as diversification of existing Japanese manufacturing facilities and also newly launched global products expansion plans. My colleague Kunal will cover more about this little later. Thank you very much, and with that I will now hand over the call to my colleague Suresh to talk about our performance. Thank you.
Thank you, Chetan bhai. Good afternoon. Good afternoon, everybody on the call, and thanks for joining us today. FY25 was a year of steady recovery and strategic progress for Sumitomo Chemical India Limited. The company delivered a resilient performance marked by consistent volume growth across key segments despite a challenging pricing environment that persisted throughout the year. Our revenue growth for the year was primarily volume-led, underscoring the strength of our domestic franchise, robust channel engagement, and timely execution of demand generation initiatives. This was complemented by sustained improvement in operational efficiencies and cost optimization measures, which enabled us to expand margins and deliver strong growth in profitability. We delivered 11% revenue growth over a year-on-year basis led by substantial expansion in volumes across both domestic and export markets, despite adverse pricing trends that impacted realization by approximately 10% in both segments. The performance underscores our commercial agility and execution strength, further reinforced by improved asset utilization and optimized distribution efficiency. Profitability saw a significant uptrend during the year. Our EBITDA grew by 33% and PAT by 37%, with both margins reaching their highest levels in our history, a result of superior product mix, strategic sourcing, procurement discipline, and early liquidation of high-cost inventory. EBITDA margin improved by 339 basis points year-on-year to 20.1%, while net profit margin expanded by 308 basis points to 16.1%. Our domestic business remained a key growth engine, supported by healthy Kharif season, strong Rabi season, and deep engagement through initiatives like our flagship campaign called Everyday Farmers Day campaign, through which we reached over 1 million farmers and many thousands of channel partners across the seasons and across the country, which helped us in the robust growth. Exports, though challenged in Q4 due to global market headwinds around select molecules, posted a meaningful year-on-year full-year growth. Our strategy of geographical diversification and product alignment enabled us to maintain resilience in key markets. We launched several new products in the last financial year, which includes products like Meshi, Portion, Army, and also we received latest registrations for 2 next-generation SCC molecules, namely Excalia Max and Lentigo, which is a rice herbicide. We also commenced commercial production of CTPR, that is chlorantraniliprole, at our Tarapur facility, advancing our backward integration strategy. Our subsidiary Barrix Agrosciences also delivered a commendable performance in its first full year under SCIL, with revenue growth of 82% and turned around from a negative EBITDA margin to a positive 16%. Together, these efforts have culminated in making SCIL emerge leaner, stronger, and more future-ready. Now, coming to the outlook for FY26, building on the momentum of FY25, we enter FY26 with renewed strategic intent and operational confidence. This year is poised to be a period of growth, supported by a favorable agroclimatic outlook, early monsoon onset, and stability in commodity pricing and sowing patterns. Our focus will remain firmly on driving volume-led growth, scaling up recently launched products, and sustaining margins through tight cost controls and optimized operations. The commercialization of Excalia Max and Lentigo, both high-potential patented molecules from SCC, is expected to significantly enhance our competitive position in key crop segments. Apart from SCC molecules, we are also poised to introduce another 3 to 4 products under 9(4) registration in India. We will continue to reinforce our domestic franchise through deeper channel penetration, customized farmer engagement program, and digital-led demand generation. The third season of EDFD, to be launched from June 15, which has already been communicated to our teams on the ground, will further scale our outreach and grassroots impact. While export markets present selective challenges, particularly in Latin America, our agile approach, expanding footprint in Africa and Asia, and robust product pipeline will help balance risks and capitalize on emerging opportunities. We also remain committed to improving operational metrics. Our efforts around inventory control, receivables discipline, and working capital management will continue to be a core priority even as we prepare for the next phase of scale. With this multi-pronged strategy, we are confident of delivering another strong year, making FY26 a defining year of resurgence for SCIL, anchored in innovation, execution excellence, and market agility and discipline. With that, I will hand over the call to my colleague, Mr. Kunal, to talk about our capex plans.
Good afternoon, everyone. Now, coming to our new capex plans, as part of our long-term strategy to expand our manufacturing capabilities and our manufacturing skill set, and also to align with our parent company, SCC Japan's global vision, our board has approved 2 strategic capex initiatives aimed at expanding our skill sets, cost efficiency, and also supporting the innovation delivered by the technical teams in India. So first such project is brownfield expansion at our Bhavnagar site for a very important SCC global molecule. We are expanding our production capacity at our Bhavnagar for this strategically important SCC invented and a globally successful molecule. If you recall, for the similar product, we had set up a capacity about 1 to 2 years back, and with the success of this first plant and the initial capacities in last 2 years, we have consistently delivered the product at a globally acceptable highest quality standards, meeting all quality standards, demonstrating very high utilization of this plant capacities and extremely competitive cost situation, including our ability to react to the global pricing pressure and competitiveness. So with this kind of a confidence which our technical teams have demonstrated, our board was very pleased to approve this capex to enhance our capacities with a further investment of about 55 crore Indian rupees, and with this we are targeting to double the capacities, and it will also means this entire additional capacities can be used to expand our exports to our parent company. This plant is expected to be completed by Q4 financial year 2026-27. This facility will enhance our ability to support the global requirement of a very important SCC molecules, and SCIL will be able to meet 40 to 50% of the global requirement. And in the future, depending upon the success and the volumes of this product and this project, we can even consider in the future if there is a need to further expand these capacities. The second project which we want to highlight is again a brownfield project at Tarapur. This product, as earlier was touched upon by our Managing Director Shasan, is a recently launched global molecule which is expected to be a blockbuster product. And in India also, this product has recently received regulatory approval for sales in the Indian market. We will be manufacturing this product at our Tarapur facility, and we will be using our existing facility with some modifications in the equipment and the line to be able to manufacture this product. The estimated capex for this project is less than rupees 10 crore, and the timelines are very similar to the first brownfield project of Bhavnagar. So the Tarapur brownfield project is also expected to be completed by financial year 26-27 Q4. This investment will also allow us to demonstrate SCIL's ability to manufacture newly launched global innovative patented molecules, and this will give us a lot of confidence to both our technical teams in India and our parent company that SCIL can manufacture new and the recently launched products as well. And it is something which is a kind of a new initiative being done by our company with the support of our parent company. And we will also be able to support the global expansion of this product in the future. And with this, the 100% of the global demand is expected to be met. 100% of the domestic demand in India is expected to be met from the production from India in next 2 years or so. This will also be a very strategic step towards a state-of-the-art, much larger capacity, backward integrated greenfield facility for the same product at Dahej. And as Shasan also mentioned, that the experience of this product in our Tarapur existing facility will give more confidence to our teams in India and Japan that SCIL can set up much larger level backward integrated facilities in the future. We are currently at the advanced level of technical evaluation in discussion with our parent company, and once this is completed, we will provide update. In next 1 to 2 years, our technical team will work in parallel on both the initiatives. These two brownfield expansions, as we have mentioned, one in Bhavnagar, one at Tarapur, and at the same time, in parallel, we are continuing to work towards setting up a new greenfield facility at Dahej. and maybe for this particular product and some more additional product. So the Dahej strategy remains for multiple products and multiple plants to be set up in next 3 to 5 years. I think our managing director has also mentioned about our Dahej expansion and its importance, and I don't need to emphasize more on this. So with this, now I request my colleague Mr. Anil Naval to please talk about the financial performance of the company.
Consolidated Q4 FY24-25 financial performance. Despite overall pricing headwinds, we recorded revenue of rupees 679 crore in Q4 FY24-25, which is up by 1% as compared to rupees 674 crore in Q4 FY23-24. Sequentially, the revenue was up by 6% from rupees 642 crore in Q3 FY24-25. Gross margin in Q4 FY24-25 are 40% as compared to 41.7% in Q4 FY23-24. EBITDA came at rupees 120 crore in Q4 FY24-25 as compared to rupees 140 crore in the same period last year. Sequentially, EBITDA was up by 13% from rupees 106 crore in Q3 FY24-25. EBITDA margin in the current quarter stood at 17.6% as compared to 20.8% in Q4 FY23-24. Profit after tax stood at rupees 100 crore in Q4 FY24-25 as compared to rupees 110 crore in the same quarter last year. Sequentially, PAT was up by 14% from rupees 87 crore in Q3 FY24-25. PAT margin stood at 14.7% vis-a-vis 16.3% in Q4 FY23-24. Now coming to our consolidated performance for financial year 24-25. Revenue from operation in H1 FY24-25 stood at 3149. So there is a correction. It's not H1. It's a full financial year. Stood at 3149 crore rupees, up by 11% as compared to rupees 2844 crore in FY23-24. In financial year 24-25, domestic agrochemical revenue contributed about 78% of our overall revenue, with export contributing the rest. In FY24-25, insecticides contributed about 40% of total revenue, while herbicides, plant growth regulator, and fungicides contributed about 21%, 11%, and 10% of total revenue respectively. From a business mix standpoint, our domestic business continued to exhibit strong momentum, growing 8% year-on-year in FY25, contributing 78% to revenues. Export revenue surged 22% year-on-year, supported by penetration into newer geographies despite Q4 headwinds. In FY24-25, sales to South America and North America increased by 78% and 44% respectively as compared to the same period last year. Our full year gross margin expanded by 337 basis points year-on-year to 41%, underpinned by favorable product mix, document efficiencies, and proactive liquidation of high-cost inventories. FY25 also marked the highest profitability in company's history. EBITDA stood at rupees 632 crore in FY24-25, witnessing a jump of 33% as compared to rupees 475 crore in 23-24. Our EBITDA margin stood at 20.1% in FY24-25 as compared to 16.7% in the same period last year. The profit after tax for the financial year amounted to rupees 506 crore, reflecting an increase of 37% compared to the previous year's figure of rupees 370 crore. Now we'll take a pause here and request moderator to open the floor for question one by one.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhavya Gandhi from Dalal and Broacha Stock Broking. Please go ahead.
Yeah, hi. Thank you for the opportunity. Just wanted to ask a couple of questions from my end. So what is the revenue expected from the two new molecules that we've received registration for, Excelia Max and Lentigo?
See, we are just about to launch this Kharif season. Our first primary objective is to ensure proper launch acceptance by the farmer through demand generation activities and deliver the performance exceeding the expectations of the farming community. That's our first objective. Obviously, once the farmers accept this molecule based on its merits and performance, I think it will go into. Our aspiration is big, but we can't commit any number at this point of time. Given the potentiality that it has done very well, wherever this product was launched, we expect it to be a good number business for India also.
Okay. So currently the technical might be imported from Japan and we might be just formulating it, or the entire formulation is being imported at the moment?
No, we are importing technical and formulating it in India.
Formulating in India. And with respect to the Bhavnagar molecule expansion that we are saying, is it a patented one, or the brownfield expansion that we are planning 55 crores, or is it a patented one, or is it a generic product?
It is not a patented one, but it is a proprietary, which means it was innovated by SCG, and it's still at this point of time we continue to have a very strong global market share in this product. So it is out of patent now, but it continues to be a proprietary.
Proprietary product. Fair enough. And just one more thing on the specialty basket, largely it has been constant only. So if we look at this year numbers, specialty has been closer to 900 crores. 2 years back also it was somewhere closer to 1000 odd crores, whereas our gross margins have improved drastically in last 2 years to 41%. Is it possible to guide at least on the gross margin? What is the long-term sustainable gross margin, and what is the outlook for specialty as a portfolio? I mean, from 1000 crores, where do we intend to take it? Maybe double it, because we've launched a couple of products in last 3-4 years. So yeah.
So in the specialty portfolio also, we have a range of products, like even some of the segments like animal nutrition, EHT, even they qualify for specialty portfolio. So while you are right that the overall specialty portfolio has remained same, but within a specialty portfolio, we are upgrading our portfolio with a newer and higher margin product. So fundamentally and strategically, whatever we need to do, that is being done, and that is what has caused and resulted into increase in our gross margins. And then all the new products launched by the company in last 3 years, which are mainly towards the agro division of the company. And as Dr. Suresh also touched upon, these products are seeing good traction in the market. And as a company, we don't push that in the initial 1 or 2 years itself the product volume should ramp up to a very high level. And historically also always we have delivered consistent growth over 3 to 5 years in terms of volumes ramp up. So with the volume ramp up of this newer product, the share of specialty should enhance in the future. And from the margin point of view, as you can see at the company level, because of the strategic initiatives of new products and high margin products, the overall margin profile has gone up by about 3.5% from 37.6 to almost 41%. And our endeavor will continue that we want to maintain this kind of margin going forward. And we don't believe that there is anything one time or kind of exceptional items in these margins which gives us some sort of indication that these margins are not sustainable. So we are very confident to be able to maintain and sustain these margins.
Yeah, just to add one comment over what Kunal said, as I mentioned during my initial comments, we launched a campaign called Everyday Farmer Day meetings, right, across the country, where the teams have been given a mandate of selected products which we shortlisted based on the margin and potential of future, including the new products. The focus of the team has been channelized into those kind of products which gives higher returns to the company. So that is also helping us in terms of product mix.
Fair enough. And just one more thing on the exports to Japan. So that number has dipped again for this year. I think we had guided that at least we will be doing 125 odd crores this year and 250 odd crores next year. by supplying to the parent. That has again missed. So if you can just help us understand what is not working or what we are trying to improvise by supplying it to our parent Japanese exports on that,
Right.
as well as on the Innofarm. Yeah.
So this exports to our parent company Japan, it consists of several products, and 1 or 2 products we were already making earlier, and recently we expanded capacities to add 5 or 6 products. So some segments and some products out of this, due to say delays in registrations globally or due to the global volume slowdown situation in last 1 or 2 years, what has caused. So we are seeing that there is a little bit of a delay in some of the products ramp up, but at the same time, while the same facilities we have upgraded to be able to make other products. So overall, in the terms of capacity utilization, we are in satisfactory level, and instead of exports to Japan, we have been able to make some products in India itself. If you see our investor presentation on slide number 5, we have also mentioned that we have started the commercial production of a very important product called CTPR, which recently got off patent, and we have started manufacturing that product also in the same Tarapur facility, and we have started sales of this product in Indian domestic market. So in terms of utilization of these facilities, we are enhancing the utilizations level every year. In terms of exports to Japan, yes, there is a little bit of a slowdown and some delays, but we are on track to grow it consistently, and with these 2 new projects which we have announced, we will be able to further enhance both the volumes and also the product portfolio, including one newly launched product also.
Right. Just last thing on the Innofarm, because the Indiflin product is already launched in the LATAM markets. So how are we seeing the response, and are we still supplying tebuconazole to the LATAM markets, and outlook for LATAM markets?
Yes, so we are supplying tebuconazole. How much this volume, how much I think Innofarm has performed, it is a kind of a third party in terms of that way it is a private company, so their numbers are not in public domain, but whatever you can see in the public domain, this product seems to be working well and has made a lot of impact in the Brazilian market. But the specific numbers we don't have access to, and it is not in public domain.
Our outlook for exports to LATAM market?
You are talking about this particular tebuconazole for Indiflin combination, right?
Yeah, and overall outlook as well for LATAM.
Overall, LATAM picked up early. Last year, first 3 quarters did well. In the quarter 4, it went a little bit sluggish. But based on our market information and all, it seems to be coming back on track. We need to wait for 1 or 2 more quarters to really see it to come back to normalcy. We are optimistic.
Fair enough. I'll get back in the queue. Thank you so much for the answer. Yeah.
Thank you. The next question is from the line of Himanshu Binani from Anand Rathi Financial Services Limited. Please go ahead.
Hi, sir. Thank you for taking my question. So my first question was largely on the capex side, the 2 new incremental capex which you have announced. So maybe if you can give a better sense in terms of the revenue and the margin expectation from those. And second, on the Tarapur side, this 10 crore capex, so this is largely catering to the domestic branded business, or this would be for the exports?
Yeah, so first I will take the second question. You are right, as we have mentioned in the presentation also. In the Tarapur, it is not. We are just modifying the lines to be able to manufacture this new product, which is globally also recently launched product, and primarily for few months production will be utilized only for the Indian domestic market, and for the global requirement we have to still study more and set up a new greenfield site at Dahej with a backward integration. So this site primarily purpose is for Indian domestic market, because in Indian domestic market itself we are expecting, as Dr. Suresh mentioned, very good ramp up of the volumes and impactful performance in the Indian market. And on your other question, the first part, which is about the capex which we are undertaking, so the margin profile of this is expected to be similar to the projects which we have delivered earlier.
Okay, and the revenue targets? the
That is
acceptance
something
basically?
which is an evolving situation, because sometimes some of these products, the pricing goes up and down as per the global situation. So at this point of time, it is very difficult because we are still, like, say, 18 months away from the commercial production. So whatever is the sales price, based on that, the top line goes a little bit up and down. But from margin point of view, we are confident that this product should be able to give us a good return on investments. And even at the company level, as you can see, like from the peak revenues of 3,500 crore, even if the revenues are lower, but as you can see, the profitability wise, we have delivered the expectation. So the same kind of philosophies are also coming up with all of these capex projects. We will not be able to very confidently give you how much revenues, but profitability wise, we will be in line with expectations.
Got it, sir. And so the second question is largely on the margin side. So if you can help us understand the margin differential between the domestic and the exports business for 4Q as well as for FY25, and how one should actually look into the overall gross margins basically for 26.
So see, as a strategy, I think, because it's a commercially sensitive information, we never disclose the specific margin between domestic and exports or between the segments. But as a trend, I think Dr. Suresh has already mentioned, and I request him to little bit expand more about the outlook and the margin expectation. But we will not be able to give a specific breakup between export and domestic.
Yeah, generally, our export business primarily we export technical grade. In technical grade, generally the margin is slightly lower than the formulation. In formulation, which is primarily domestic market, we invest quite a bit of marketing and promotional activities. Naturally, the margin, would be slightly higher compared to the technical grade pesticides. And we have delivered, a record margin, like, when Anil spoke or Mr. Chetan Shah spoke, we delivered the highest ever margin in terms of absolute number and also in terms of percentage. And during my comments also, I mentioned that we would like to further strengthen it with the launch of the new products, with more focus on intense demand generation, high margin, gross margin products. Our endeavor is to increase the margin compared to what we delivered in 24-25.
Right. So maybe differential basically into the exports and the domestic margins. Any ballpark numbers would be good.
Again,
I'm sorry, we will not be able to give any forward-looking specific numbers.
Sure, sir. Thank you.
Thank you. The next question is from the line of Chintan Modi from Haitong Securities. Please go ahead.
Hi, thank you for the opportunity. Sir, could you highlight how much was the revenue achieved from those 5-6 molecules in FY25, which is specifically made for the parent?
So see, as you can see, we do not give the specific product-wise breakup and all, but you can see that from the numbers in the presentation, the total exports to Japan is at about 100 crore plus level.
Okay. Second, with respect to the margins, see, for these products that you are talking about, like, the two new plants, which are, newly launched product that you will be manufacturing. So when you do this for your global, and everything is similar to what Japan follows, or there is some process innovation that is being done in India by the Indian team?
So I think these two are the different products. One is a newly launched product, and one is the product which we are already selling in India for many years and already making in India for now 2-3 years. So on that particular product, a lot of innovation has been done by SCIL in India. And even before starting the manufacturing 2 years back, a lot of process innovations were done. And those kind of activities in terms of process innovations and some efficiency improvements on a gradual and consistent basis continues by our team on a regular basis without significantly changing the characteristics of the product. So that kind of activities continues. For the second product, which is just a newly launched global product, which will be starting the manufacturing in next 18 months or so. So for that, to start with, we are following the global processes, and gradually, once we start the manufacturing, we will look at the opportunities to optimize the processes. And also, when we set up a larger scale new plant which is backward integrated at Dahej for the global requirement, that time also we will see that how much process innovations can be done.
Okay. And so in the similar context, so the margins that you make on such kind of products that where you would have done some process innovation is generally higher than your domestic margins or similar to the domestic branded business?
Broadly, it is similar, and what I think we have always maintained whenever we announce any kind of a capex is that any of these investments will not be negative for our existing company level margin. So in these kind of projects also we are earning at a company level margin. But I think Dr. Suresh also touched upon, because some of these products we are exporting technical to our parent company. So in terms of margins for formulations or margins for marketing and distribution of the product, that is something which comes in the global affiliates, and that is something where the both efforts and margins are not being coming to SCIL. But at the same time, in the domestic market, we get also the margins for the formulations, for distribution, for marketing, and all those kind of activities, because we accordingly take that much efforts and costs also.
Also, the process innovations is not only important because these are off-patent products. So it is not always true that you innovate or you have a process improvement only for making profits. Sometimes you have to be, technologically ready to face competition from China or any other part of the world, basically China. But you have to be ready to compete with them. So the process innovation is also an important part as to how well you can be in a competitive position. So you can't afford to lose your volumes.
Understood. Sir, one last question is with respect to, your parent company has come out with a business plan 25 to 27, wherein they have mentioned about some foray into semiconductor chemicals in India. So I would like to understand if you have been in talks with the parent company on these lines.
Yeah, so yes, you are absolutely right. In our parent company's strategic growth plan, they have announced that our ITCM sector, which deals with this kind of chemicals and semiconductor-related chemicals, is looking to expand into India, and we are in discussions with them, and we are jointly evaluating the opportunities in India. No decision has been made at this point of time, but we are studying the Indian market in terms of the overall evaluation of the semiconductors and all those kind of a thing. But we are very much hopeful that whenever our parent company decides to expand this business in India, we are hopeful that SCIL should be considered suitably by our parent company.
Understood. And sir, with respect
Sorry to interrupt,
CPR,
sir. I would request you to please rejoin the queue for your follow-up question.
Sure. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please limit your question to 2 per participant. If you have a follow-up question, I would request you to rejoin the queue. The next question is from the line of Ankur from Axis Bank. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congratulations for a good annual performance. First question on our capital allocation as well as the capex plans. If I look at the time frame over FY22 to 24, we had seen some sort of ramp up in our capex, annual capex to around 150 odd crores annually. But again slowed down in FY25 while we are sitting at a strong cash balance of 1600 crore plus and generating more. So just wanted to gather your thoughts. How should one look at this space given that the Dahej is still largely underutilized as an asset?
So Ankur, see what has happened is, as you are aware, that last 2 years the global agrochemical industry faced significant challenges. If you look at the results, especially volumes of any agrochemical company all over the world or in India, everyone has suffered significant volume drops due to several structural problems, and now those things are coming back to the normal. So in last 2 years it was a very, very difficult situation. Some of the projects which we had approved before this kind of a challenging situation we completed, but in last 1 or 2 years there was certainly that there was, due to the the challenging volume situation globally, it was less confidence for us to go ahead and incur capex and add up more and more capacities. But now, since the situation is coming back, we have restarted that kind of a process, and we have approved some of the projects. In addition to that, there will be a normal capex which we anyway incur for some existing products debottlenecking. So with all of these things, now we feel that we will be back to the normal trend. And you are absolutely right, last 1 or 2 years there was slowdown in capex, but we feel that going forward that situation should be behind us, and going forward we should be having more confidence to be able to add capacities both for our domestic requirement and also for the global requirement.
Thanks, Kunal. Just to follow up on that, so this capex expansion that we plan to do, this will be largely for the debottlenecking led, or let's say for the domestic business as a market, or it is largely dependent upon newer products ramp up from the export market from Sumitomo, from our parent perspective, and that will be the bigger driving factor here.
Both. But I would say the second part will be the bigger driving factor. The first part anyway continues, the debottlenecking and those kind of a small thing. But expansion of manufacturing for more products, additional capacities for the global requirement, that is something which is expected to drive the utilization of the Dahej and also the capex plan going forward.
Sure. Second question on our margin profile as well as the specialty revenue bit. You did allude towards rejig in the portfolio, which has probably kept the revenues flattish, the specialty part of it. Is that rejig lastly over, and hence we should see a sharper sort of revenue ramp up starting FY26? And second commented question to that is on the gross margin improvement there. Should this trend continue in the coming years as well, given that newer product ramp up, launches, etc., still accelerates? Or there is some cap to that EBITDA or gross margin that you want to make?
So you are right that this process of maybe slowdown in some of the low margin products in specialty and focusing more on new products and high margin cycle will in portfolio. There are still some products in our specialty which are not yielding very good margin, and maybe there could be a slowdown of some of these products. So that kind of exercise may continue for maybe 1 more year, and this should naturally result in higher margin. So as you have seen last year also, since we reduced focus on some of the low margin product and focus more on high margin new products, our margin profile improved. So while the top line may have some problems because of this, but at the margin level it should be positive for the company and for the long-term interest of the company, because we want to less focus on the products which are adding very low margin, acquiring a lot of investment in terms of working capital, and that kind of a decisions and evaluation is being done for the low margin products.
Sure. Earlier, just following up on that, earlier we had mentioned that we were good at 20% odd, EBITDA margin there. Does that thought remain the same, or because of the operating leverage, if theoretically the margin goes upwards of 20%, we are okay with that?
I think that ceiling which we had in our mind, that margins more than 20%, which we have been mentioning in the past, I think we are behind that, and we have realized that in this year also, if you see, we have delivered EBITDA margins which are higher than 20%. So we have already broken that ceiling, and from the mindset point of view also, now we understand that since we are not focusing on the top line growth, since we are not focusing on some of the low margin product, naturally the margin profile will go beyond 20%, and it may go beyond 20% if the trend continues like this.
Good to hear that, Kunal. Thank you and all the best.
Thank you. The next question is from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Thank you very much. Can you give us the volume growth for fourth quarter, and also explain why there was a dip in gross margin in EBITDA, and the overall profits were down compared to the last period, especially since the Rabi this year was possibly one of the best we've had in recent years?
Yeah, if you look at first, let me talk about full year. If you look at our full year, as we commented at the beginning, our full year volume growth has been almost 20%, both in domestic as well as export market up to quarter 3. Even in quarter 4, domestic market grew very nicely, almost 15-16% growth in the domestic market. Whereas in the export market, primarily because of LATAM, our volume got hit on account of two. One, the price drop compared to the previous Q4, and also volume has taken a slight hit in terms of Q4 compared to the previous year in exports. See, these are the reasons why our Q4 overall margin has also gone down. But overall, we look forward for continue to better the performance year on year and quarter on quarter compared to the previous quarter or previous year. That's our endeavor.
Okay, can I just get some housekeeping confirmation on the export number for the year and the quarter? So if I do the calculation based on the segment percentage, I get an export revenue of around 690 crores for FY25 compared to 568 crores in FY24. So is that number correct?
It is slightly different based on our understanding. It is about 677 but around 675 to 680 crore level in current year, and last year it was more about a little higher than 550 crore. And if you specifically asked about Latin America, so Latin America revenues, because it is already there in the investor presentation, are I think last year against the revenues of about 135 crore, this year we have delivered revenues of about 240 crore plus from Latin America.
And for the fourth quarter also, can you give similar numbers? I have a number of around 274 crores for exports in 4Q25. And last year, 4Q24, I have an export number of 285 crores.
I think there seems to be some confusion. I think as per us, the numbers for current year, fourth quarter is much lower than what you mentioned.
Yeah, because we are trying to reconcile the year-to-date numbers. So we don't have the fourth quarter percentage, right? So if you can clarify that, that would be useful to, get the base right.
As for us, it is more like, I think whatever numbers we have, I think in the annual report also, I think these numbers will come. But as per us, the last quarter, current year 24-25, the exports numbers are more in the range of 210 to 215 crore.
Okay.
So in last year of 260 crore plus. So there is a negative delta of about 50 crore in the current quarter coming from the exports. But again, as this is again a quarter to quarter situation, this sometimes some shipments sailing in December last week versus January last week, first week or so. So I don't think we should look at so much quarter to quarter thing in this kind of a markets and this kind of a situation. If you see full year basis, we have delivered significant growth both in Latin America and the overall exports market.
Yeah, understood. So in terms of the capex for Bhavnagar and Tarapur, are we talking about the two products, the fungicide and herbicide, which you are trying to launch, or is the capex in Bhavnagar for CTPR?
No, Bhavnagar capex is not for CTPR. CTPR is not a Sumitomo molecule. It is a third party off patent molecule. Already several players in India, in China, all over the world have launched this product, and we have also started making this product in our Tarapur facility, which was already available. So we have not incurred much of the capex for this, and we did not even announce any kind of a capex for this, and we have just commented in our investor presentation that we have completed this project and we have already started making this particular product. So there is no capex which we have announced for CTPR. And in Bhavnagar, we were making one product for our global requirement, wherein we are enhancing the capacities to doubling the capacities. And the Tarapur project is for a fungicide.
So Tarapur project is for that Exalia Max?
We don't give any specific product information, but yes, from our commentary you can get some guesses, but from the commercial and strategic point of view, we don't mention any specific product for any capex.
Yeah, so the Bhavnagar capex of 55 crores, can we conclude it's for that Lentigo herbicide?
No, it is not for a new product. It is for a product which we are already selling in India for many years, and we are already manufacturing in Bhavnagar. 2 years back, we had set up a project for that. It is for that product where we are increasing the capacity. But it is not CTPR what you mentioned. It is some different product.
Okay.
It is an insecticide.
Okay. So to just put all this in perspective, you had invested about 120 crores for the 5 molecules to be exported to Japan, right? So is one of these expansion an extension of that investment? How do we rate that?
Yes.
Okay. So the investments for Exalia Max and Lentigo are yet to be made, right? That is supposed to sometime in the future.
No, see, Lentigo, there is no plan right now. Lentigo is a product which is a patented product manufactured globally, and in India we are just launching this product as a formulated product. The Excalia Max or other products, as we have mentioned, this is a globally patented product. The starting point is we will be importing this product technical, we will be formulating in India and selling in India, and we are looking to manufacture that product in India starting maybe in next 18 months or 2 years with a smaller capacity for Indian domestic requirement, and in the long term we are technically evaluating if we can set up a global scale backward integrated plant at our Dahej site.
Thank you. Participants are requested to limit their question to 2 per participant. If you have a follow-up question, I would request you to rejoin the queue. The next question is from the line of Nausid Chaudhary from Aditya Birla AMC. Please go ahead.
Hi. Thanks for the opportunity. 2 clarifications. First, on the margin side, just wanted to reconfirm on the margin profile of export business, because in past in our multiple interactions, what we could understood, there is a few percentage difference between export and domestic margin. Has that gap narrowed, or is there a case that in future this gap can narrow? If you can comment qualitatively on this, please.
So I think what I understood your question, you are asking about the difference between exports versus domestic margin?
Yes. And can this, if there is a gap, any, can this be?
So see, as we explained earlier, in the exports.
Can I?
Yeah.
No, see, the point is that when you compare export business and domestic business, there is a very big difference. The difference in domestic market is that we are talking about selling our formulated brands. We may be manufacturing technicals as well, but when you convert those technicals and you convert them into brands and you market those products for domestic markets, the margins are different. Now, we are also selling our technicals in B2B market. Right? And exports, we are also selling technical more than the formulation, the reverse of domestic market. So in domestic market, we are selling more of our brands, less of technical. And in export market, we are selling more of technical and less of brands. But if you compare the margin between B2B domestic and export margins in technical, they would be similar. They would be absolutely similar. But you cannot, brand business margins will be definitely higher than selling a technical, either domestic or export.
Okay. I understood, sir. Thank you for this. And second, on our new the launches 9(3) and the pipeline which we have, if you can highlight which all key crops are we targeting or focusing, or how do we decide